Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. Later on, we'll be talking with Vitaliy Katsenelson, the Chief Investment Officer at Investment Management Associates, Inc., a value investment firm based in Denver, Colorado. He's not just another investment guy. This is quite a guy. First, he has a very interesting way of classifying markets meaning national markets over a period of years. He says we are currently in a sideways market, and that has implications for how one should invest. I assure you it will be quite interesting. But let's talk about delusion, the delusion of scientists. In the 1957 courtroom drama, 12 Angry Men, directed by the great Sidney Lumet, Henry Fonda played an architect, a man of logic and structure compared with the rest of the jury, who were voting 11-1, Fonda being the lone holdout, to find the poor young man guilty of murder. Fonda, wearing a white jacket which looked a lot like a lab coat, in a way, leads the jury through dogged questioning, skepticism, examination of the evidence, re-examination, tedious to some in the jury who just wanted to go home to their dinners. Well, the man of logic and structure and reason convinced the jury, turned them around to 12-0 for acquittal. Now, the jury was portrayed as filled with people of self-deception. Sigmund Freud in 1930, in his Civilization and Its Discontents, pointed out that human beings in general have a powerful tendency toward self-deception. He even said, in that, even the least among us is a genius when it comes to self-deception. So that's the least among us. Regina Nuzzo, in The Current Nature, dated October 7, 2015, includes scientists themselves in that group. Her first line is, humans are remarkably good at self-deception, but growing concern about reproducibility is driving many researchers to seek ways to fight their own worst instincts. Reproducibility refers to whether an experiment can be reproduced. You do an experiment, its results are interesting, you hurry it into print without reproducing it, and later it turns out it cannot be reproduced. The name of the article is How Scientists Fool Themselves and How They Can Stop. She notes, this is the big problem in science that no one is talking about. Even an honest person is a master of self-deception. Again, Freud. And I can tell you, I know some former academics. I'm a former academic. Even smart people self-deception turns smart people into jackasses when it comes to human relationships sometimes. Because think about it. If you have a facility with an attraction to theory, that is a positive explanation that covers certain phenomena, well, you might have the tendency then, afterward, to fit things into the theory, ignoring puzzles, relevant new evidence, anything that doesn't, or just downplaying the significance of factors that lie just beyond the range of the theory. Ms. Nuzzo's article is very long and very interesting and offers a typology of self-deception. While we're on the topic, the Sunday, September 26, 27, 2015 Wall Street Journal, the invaluable Jason Zweig's The Intelligent Investor column talks about a similar phenomenon. He quotes Professor Philip Tetlock. What you think is much less important than how you think. And that good forecasters regard their views, quote, as hypotheses to be tested, not treasures to be guarded, end quote. I can assure you, based upon my experience in the academy, there's a lot of treasure guarding going on. Zweig notes that experts when it comes to the market are paid not just to be right, but to sound right, to be cocksure even when the evidence is sparse or ambiguous. And he notes, Zweig does, that 3/4 of all stock mutual funds have failed to beat the market over the past decade. What does that say about the forecasting abilities of those who manage these funds and are compensated handsomely to do so? Last year, 98% of economists expected interest rates to rise, but they fell instead. What does that say about the validity of whatever it is the economists are using to analyze such questions? Most energy analysts did not foresee oil's collapse from $145 a barrel in 2008 to $38 in the summer of 2015, or the 15% rebound since. The name of the book Zweig is reviewing in this column is Super Forecasting, The Art and Science of Prediction by Philip Tetlock. And the book itself is based upon empirical data. The Good Judgment Project is called, which pitted some 20,000 amateur forecasters against some of the most knowledgeable experts in the world. In summary, it turned out that after rigorous statistical controls, the best of the amateur forecasters were on average about 30% more accurate than the experts with all their access to classified information and, one might say, all of their historical knowledge of that on which they were forecasting. What's more, the full pool of amateurs also outperformed the experts. A very curious outcome. And Zweig, describing Tetlock's work, says, the most careful, curious, open-minded, persistent, and self-critical of the forecasters did the best. Those characteristics were measured by psychological testing. So what can you do when you're thinking about investing in a startup to think clearly and not like these befogged or overly self-impressed experts guarding the treasures of their insight? Well, Zweig says, start by, and I'm sure he's channeling Tetlock, start by zeroing in on the base rate, the average historical experience. So if you're considering whether to invest in an IPO, don't first get impressed by the company and how wonderful it is. Instead, begin with the assumption that this IPO will match the returns of the typical IPO. Typical IPOs underperform the rest of the stock market by 2 to 3 percentage points annually in the long run. All right, now you have this mediocre base rate. Then ask yourself what the company would have to do to outperform that average by, say, 4 percentage points annually so that you can beat the market. Work up a list, do some research about other companies in the past that have beaten the market, and see which factors they seem to have in common. Does this IPO have those factors in its favor? And importantly, write down your reasoning in detail. Estimate the numerical odds as precisely as you can that you will be correct. So there you go. Democracy in action. The ordinary folks beating the pundits, beating the scientists, beating the economists. Well, let's move on and see what Mr. Katsenelson can do to make us think more clearly about the market. Today I have with me Vitaliy Katsenelson, who is Chief Investment Officer of Investment Management Associates, Inc., which is a value investment firm based in Denver, Colorado. Mr. Katsenelson is author of Little Book of Sideways Markets, which I gotta say is a very delightful title, which was published by Wiley in 2010. He also wrote Active Value Investing, published by Wiley in 2007, as well as many articles for leading finance publications and newspaper business sections. Vitaliy also invests. It is his life's passion. He is on sabbatical at the moment from teaching investment to graduate students at the University of Colorado. As he sums his professional career, quote, I invest, I educate, I write, and I could not dream of doing anything else, end quote. All of this in his second or third language. Vitaliy was born in Murmansk, Russia, the home of Russia's Northern Fleet. He emigrated to the U.S. from Russia in 1991, a story in itself, which you can read at his blog, which is found at www.contrarianedge.com. Welcome to the show, Vitaliy.
It's my pleasure. Thank you.
Really great to have you on. So your book titles are meaningful. They indicate, first, one of them indicates one of your chief macro insights. Another one indicates your overall orientation to investing. So first, the little book of sideways markets. I want to frame this question by referring to the 2009 financial crisis. Mm-hmm. You regard the entire period from 2000 to the present as one market, as a sideways market. A lot of people would have thought that before the financial crisis it was a bull market, but I guess what you're saying, it was merely a bubble and not a bull. What's a sideways market?
Okay, well, let me touch on my first book because it relates to my second book. So in 2005, I wrote this article for Financial Times. In that article, basically, it was talking about that it's very likely that the market ahead of us is going to be a range-bound market. And then a friend of mine came up to me and said, I'm going to put a book together with 10 other money managers. Would you like to write a chapter? And so I thought I was going to write about this range-bound market that is described in that article. So I started to write it, and it kind of spilled into, instead of being one chapter, 4 chapters or 5 chapters. Mm-hmm. And so I approached Wiley and said, well, I think there's a book here. And so in 2007, I published the book. I guess the book got published. It was called Active Value Investing, Making Money in Range-Bound Markets. 280 pages, 75 charts. Basically written for professional investors. In 2010, I took the first book and basically kind of simplified it, and that book was converted into the little book of sideways markets. And that book was written basically for dentists and doctors, for somebody who is sophisticated but not a professional investor. So the difference in titles is originally I called this markets range-bound markets, when it was book written for professionals. And I felt, that firm is too clinical. And that's why in the second book it was called Sideways Markets. So let's talk about sideways markets or range-bound markets. So historically, if you look over the last 100 plus years, if you looked at secular markets or long-term markets, I'm talking about markets that last maybe 10 years or longer, on average, markets were either bull or either bull markets going up or sideways markets going up and down and going nowhere. So there was a lot of volatility. So, and that volatility you would call cyclical markets, so kind of a short-term markets that last maybe a few years. So, and if the last sideways market we had was from 1966 to 1982. And during that time period, over those 16 years, you had, I think, 5 bull markets and 5 little bear markets. When you look on the chart, it kind of looks fairly harmless, but there were periods of times where market declined over 50%, and there were periods of time when market went up over 100%. There was a lot of volatility, and I'm sure when people lived through those markets, they would have treated those bear markets as a big bear markets and bull markets as big bull markets, but in reality they just lasted a few years. So in 2000, so my argument is in 2000 we entered into a new sideways market, and these sideways markets are created, and actually bull markets as well, not because the economy is growing at a faster rate or slower rate. Historical economic growth rate has been fairly consistent during the market cycles. What caused the kind of cycle of bull markets or bear markets or sideways markets was price to earnings, stocks valuation. So at the end of the bull market, stocks become very expensive, and as the price to earnings declines, it goes from above average, through average, and below average. That decrease basically wipes out all the benefits you get from earnings growth. In the meantime, you have a lot of volatility. But basically, that's what's called the sideways markets, and in 2000, stock market valuations was the highest ever.
Mm-hmm.
And today, fast forward 15 years, it's still about 50% above average.
Okay, but let's just reprise something you said. So range bound and sideways mean the same thing, and it means that if you take and I'm looking at a chart compiled by you that goes from 1900 on the left-hand side to 2010 on the right-hand side, and it shows a squiggly line going up, but it flattens and goes up and flattens. And when it flattens, as far as the Dow Jones Industrial Average, it's a sideways market. When it's going up consistently, that's a Dow Jones market. But as you said, there's volatility within, hyperventilating financial journalists within, a lot of market pain and pleasure within, but still a sideways market is fundamentally different from a bull market. So let me just restate, I think, something you just said. In a sideways market, price to earning ratios go from much above to much below average. I think what you were saying is they go from being very expensive to being less expensive. Can you amplify that maybe with an example or talk about its significance?
Sure. So let me give you this example. And I'm right now when I quote these numbers, I'm using 10-year trailing numbers. And so let me explain what I mean. So the price to earnings is basically price divided by earnings. So we know what the price is, and earnings. And this is where it gets very subjective. Some people use 1-year trailing earnings, and the problem with that number is that it's extremely volatile, and it could be impacted by profit margins that could be cyclically high or cyclically low. So that's why, when you look at secular markets, it's wise to look at the earnings of previous 10 years and average them, and then compute the price to earnings this way. So the average number would be about 18, 19 times. Now, if you look at the price to earnings over previous 100 years, where the earnings are 10-year average earnings, so the average number would be about 18.7 times actually. So in 2000, that number got to 49, which is almost 2.5 times above the norm. Today, that number is at 30, still significantly higher than the historical average. In the previous sideways markets, let's take 1966, it was in the 26 times, and when the sideways market ended, price to earnings was at 10. So average, let's say 19. So above average is 26. It goes to average, below average, and at 10 stays there for a while. And that's when that's when sideways markets end.
Well, let me ask you this, and I believe it's probably a stupid question, but I'll ask it anyway. Is the movement in the price to earnings ratio from the beginning to the end of a sideways market a psychological phenomenon, a sociological phenomenon, or is there some sort of underlying economic phenomenon?
It's a great question. I think it's a very fair question. It's a psychological phenomenon. When during bull markets, if people were rational all the time, stocks would trade at average valuations all the time.
Before you go on with that line of discussion, if people were rational all the time, we probably wouldn't have a species anymore, would we? Just anyway.
That's absolutely true. No. If people were if people were at the average state all the time, then we would stock would trade at 15, 18 times earnings. It depends what price earnings you use, and stock prices go up 5 or 6% a year because that's what the economy is growing in the long run. Okay, but people aren't, and therefore they get when stocks are cheap, earnings are growing, and price earnings starts to expand. So therefore, the return investors receive gets supersized because price earnings are going up.
Yes.
And as the return from stocks becomes meaningful, and it's people look and say, oh my God, the stocks went up 10-15% a year for the last 5 years. They start jumping into stocks, and that when they start jumping into stocks, they drive price earnings higher and higher. And price earnings is like a pendulum. It goes from one extreme to another. And so when they drive it to a very high level, that when they drive it to a very high level, it stops going up at some point. And when it stops going up, people get disenchanted. They get frustrated with stocks, and they start pulling money out of stocks. And suddenly, so you have the pendulum going another way, because people now, by selling stocks, they're driving P down, and returns from stocks are horrible, and they basically start looking for other asset classes. And it's when people throw the towel on stocks and say, I don't want to be in stocks ever again. This is when kind of this bottoms in this secular bottoms are formed in the stock market.
And it's not just people thinking that, it's the chattering classes reinforcing that. So that becomes a sociological aspect of the phenomenon, would you say?
Absolutely.
Yeah. Well, let me ask you another technical question, which maybe just will reinforce what you just said. By the way, let me stop here. We've gone from a 49 to a 30, a 49 2000 as far as price to earnings ratio, to a 30 now. So that's a decline. And yet, 2014, the S&P 500 went up a large amount, something like 14%, 13%. But that's just one of those little blips that happens within a sideways market, right?
Well, absolutely. I mean, if you just look at the chart from the sideways markets from 1966-82, there were huge swings in stocks, and every single time when the stocks went up, I don't know, 50 or 100%, people thought, oh my God, this is the bull markets of the past continuing, and every single time they got disappointed until the stock's valuations got very, very low.
All right, so the important thing, number one, which you've already established, is that you have to get 3 kilometers up and regard the market from historical perspective as a sequence of these changing types of market. And so now we're in 2015, and we're in the middle or so, maybe in the middle of a range-bound sideways market. And now you say, as I'm quoting you from somewhere, that corporate earnings growth over the next years will lag behind GDP growth. What do you mean by that, and what's the significance of that?
Okay. So think about an economy as if it was a company. Well, actually, let's look at this economy as an economy. So in the long run, economic growth rate was about 5 or 6%. And it was like that for a couple of reasons. So you had maybe 1 or 2% because of population growth. You had another 1 or 2%, let's say, from productivity. So let's say the kind of before inflation growth was about, let's say, 4%, maybe 3%. And then you had another about 3% inflation. So revenue growth of the economy, or GDP growth, was about 6% historically. Then also then you had earnings growth, and earnings growth is basically a function of two things, really. It's a revenue growth and what happens to profit margins. If corporate profit margins go up, then earnings growth will be at a faster rate than growth of the economy. So if profit margins, let's say, go from 5 to 10%, then earnings growth will be growing over the period of time at basically
quicker,
multiples and multiples, of what the economy is growing.
Right.
So, but the problem is profit margins are just like price to earnings, they're mean reverting. In other words, it's a finite growth, and a lot of time, and all the time, when you get excess profit margins, at some point you're going to pay for that. In other words, at some point they're going to mean revert and they're going to decline. And the reason that happens is because, as Jeremy Grantham put it, capitalism works. When you have one company earning excess profits, another company looks at it and say, I want some of that.
Yep.
And they start competing with that company, and they compete those excess profits away. So every single period of time when earnings growth was at above average level, that means basically that the profit margins expanded. The period that followed was when earnings started to grow at a below average level. It's just like the laws of financial gravity.
Yeah, they begin coming for you. They're gunning for you. Well, okay, so this is important because to appreciate the active value investing method, one has to appreciate the view from 3 kilometers up that we've been exploring, I think. All right, so given this step-by-step development of the American economy. What is it then that investors should, if they are rational, do to take advantage of this dynamic you've laid out?
That's a very good question. So, to kind of, when you look at, so everything I just told you has also been kind of supersized by what's also going on in the global economy. Okay, so we are not living today in a normal economy as well. So we basically live in an economy that's been over-leveraged and over-steroided by central banks as well, in addition to that.
Yeah.
And therefore, there are additional adjustments that have to be made, not just for the sideways markets, but also for what happened in the last 6 years with the global economy. And so Charlie Munger has this, who's a Warren Buffett's right-hand man, has this saying, I want to know where I'm going to die so I don't go there. So tell me where I'm going to die so I don't go there. So I'm going to paraphrase it. Figure out what can kill your stocks in your portfolio, and then adjust your process accordingly. So profit margin. So let's talk about the kind of what's going. So we have interest rates today that are at extremely low levels. I don't know when, but the risk, if you own, and the risk is that interest rates will go up at some point, and they go up a lot. So the first thing you want to do, you want to make sure that if you own companies that are not overly leveraged, and they don't need to use a lot of leverage in the balance sheet. So some companies, for instance, chronically have to use debt. Like if you think about master limited partnerships, like in oil and gas or real estate investment trusts, those companies, their business models don't work without debt.
Immense purchasing that they have to do for capital goods or real property in order to function, and that requires taking out huge amounts of debt. Plus, they get the tax benefits. It makes more sense, it's more rational tax-wise to do it. So these companies that you just identified are very exposed all the time to high leverage.
Yeah, it's their return on capital. If is so low that without debt, their business models would just make no sense.
Okay.
And so therefore, if interest rates jump at some point, two things. First of all, a lot of the stocks have been owned because of the yield. So their valuations will get hurt because of that, because suddenly when it rates at 8%, 4% yield in 5% yield in MLP or REIT are not attractive anymore. That's point number one. Also, because they use a lot of debt, their cost of borrowing will skyrocket as well. So their earnings will decline. So some of these companies have locked in their debt for a long time, and those companies will not be impacted as much. But at some point, they're going to have to refinance that debt, and that's going to impact them. So that also, when you, as a value investor, I'm looking to buy $1 for less. Okay, so I'm looking to buy it, and the difference is called the margin of safety. So I'm looking, if in a normal environment you're looking to buy $1, let's say for 70 cents. In today's environment, you want to increase your margin of safety, the discount to $1, significantly. So maybe you want to buy $1 for 40 cents. That's going to make your stock selection process very, very difficult, especially when the stocks are very expensive. And that is all right, because that means if you can't find out good stocks to buy, if you can't find those $1 for 40 cents, you're going to have more cash.
You're better off hanging on to your own dollars.
Yes. Cash has a if you own cash in the long run, that's not a good asset to be in.
Right.
But I would argue cash is better than overvalued assets today.
Let me just make sure that gets repeated. That cash in a sideways market, cash is better than equity in an overvalued asset. Got it.
Yes.
Continue, please.
Yes. So you have to be very humble about our understanding of current environment, because let me quote Charlie Munger again. If he said, if you're not confused about the global economy today, you don't understand it.
Yeah.
Okay, and so we don't really have a playbook for today's environment, because we never had an environment where all the asset classes were inflated by central banks globally just basically taking interest rates down to zero. It's never happened before. So we have no idea how things are going to play out. And it's almost, I wrote this article where I argued that kind of the DNA of the global economy has kind of been mutated by central banks. And you kind of see this when you, 6 months ago, 8 months ago, we saw Swiss franc go up 16%, I think, in one day.
Oh, yes.
So if you observe currency markets, 0.5% movement in the currency market is considered to be huge. Those usually they move very little every day. 16% is unheard of, and this is not a banana republic. This is Switzerland. So, and then we saw oil prices basically drop 50% over 6 months period. That's not normal either. Again, and while we don't have a recession,
right.
Then recently we woke up one day and found out that Apple declined 15% on no news, just because Dow dropped 1,000 points. This is not a behavior. Stocks go up and down. There is nothing new about that. But stock market decline, Apple dropping 15% for no reason, then that tells me that you have a lot of assets in weak hands. Let me explain what I mean. So historically, if you were a saver, you would have probably owned, corporate bonds and maybe some treasuries, right? But because interest rates were taken down to a very low level, if you used to own treasuries and now if you own 10-year bond, you're not going to get anything. You're going to get 2%. So that's not very much. So you're forced to start owning junk bonds.
Yep.
Much higher risk bonds that now yield maybe 4.5%, 5%. So, and if in the past, if you own junk bonds, now you're forced to buy master limited partnerships because they yield 6%. So what happened was everybody was shifted onto a different risk level that they're accustomed to. So there is a significant mismatch between assets and the holders. The good thing is that over the last 6 years, you only observed the return, but you do not observe the risk of those higher risk assets. But at some point, there is a reason why the junk bonds yield, usually,
right.
Much higher than 4%, because the default rates are much higher in the long run. So at some point, when defaults go up, you're going to have a lot of people who own junk bonds that will be freaking out and selling them very, very fast. So you're going to have this kind of. So I guess what I'm trying to say is that the volatility going forward is probably only going to be higher. And I would rather own stocks that are incredibly undervalued than assets that are overvalued today. And another thing is that you don't want to have basically forced decisions. These low interest rates are kind of forcing you to make decisions because you're buying things you don't want to, but you have nothing else to do. At some, it's going to work until it won't, and when it won't, it's going to hurt investors significantly.
Well, yes, I think. I mean, we talked a little bit about cyclical volatility within a sideways market, and you're identifying a special kind, I guess, that obtains today and makes things still more complicated, maybe even harder to do what it is, I take it, that you wish to do, which is what you just said, which is find undervalued stocks, and then the next step would be to sell them at the appropriate time. And I guess I want a little bit of comment on that before we return to the psychology of it. How do you find an undervalued stock, and how do you know a target sale point to assign to it?
That's a great question. So the way we analyze stocks is basically as if you were buying the whole business. When you were if you were to go out to buy a McDonald's franchise or a gas station, you would try to figure out what the earnings power of this franchise or gas station is, and you would not look out just next year. You would look out 10 or 15 years out,
yes.
And then the value of any asset is basically present value with future cash flows. Mm-hmm. So we value business as if we just did not just own a small fractional ownership, but we own the whole business. and that kind of tells us what the fair value is. There's a lot of analysis, a lot of assumptions, a lot of modeling that goes into that. But at the end of the day, it's just basically kind of, a common sense analysis of, just as if it was not a publicly traded asset, but just an asset.
Can I break in just for a second? Because you talked earlier about how if there's a company with a high price to earnings ratio, others are going to come gunning for it. I think that's what you said. That when a company has a great deal of earnings, rather, that is when other participants in the field will show themselves and start competing. So one aspect of an undervalued company would be one that has these other qualities, but also has high barriers to entry, perhaps in that field.
Oh, absolutely right. So
yes, for just as an example, it's just one little factor.
So no, I think you're absolutely right. So when we analyze a company, we try to figure out its normal earnings power. So if company's profit margins are high today, and we're probably going to assume that those margins are not sustainable in the long run, unless it has this incredible competitive advantage moat around it that would protect it. Those are usually the exceptions. You don't find that many of those that can sustain very high margins for a long time. But especially when you look out 10 years, 10 or 15 years out, you basically want to be very conservative in your estimates. So we stress test our analysis. We try to, what we try to do, we try to kill a company. We try to imagine different scenarios, what could happen to it, and if we can kill it, then it becomes a candidate for us to buy it. If it's priced right.
If you cannot kill it, if it's resistant to being killed. Yes.
If we cannot, we try different assumptions and it's still significantly undervalued, then it becomes a candidate for us to buy. One last test we do, we want to make sure that this is the type of company that we are going to be rational owning this company in the long run. Let me give you an example. So, like for instance, I know that personally I would not be rational if I owned the oil company or gold miner. For one simple reason, when those companies' revenues are tied to price of a commodity, I'm as an investor going to be very fickle and very nervous what the commodity price is going to do. My imagination usually runs crazy when about commodity prices. So I will probably buy high and sell low because I would not be a rational investor. So therefore, we choose very careful which companies we buy to make sure that we buy companies which are, when we own which, we're going to be rational. And everybody has their own, kind of companies that that they should identify that are not going to be rational owning these companies. I have a friend who refuses to own grocery stores, and I don't know why. Maybe at some point either he lost money on the stock, or maybe when he was 10 years old he was caught shoplifting. Who knows? But he says I will not be rational when I'm gonna own a grocery store. So he never buys grocery stores. But anyway, you ask a question, when do we sell it? Well, once we figure out what it's worth, what it's worth becomes kind of a fair value, and that becomes our sales price. And we usually don't look at the sales price as just one point. We look at it as a range. We have a low, kind of as a band almost. We have a low and high band. So we sell usually half when it gets to the low end of the band, and sell another half when it gets to the high band.
On the theory that it's not going to decline because of the intrinsic value of the company, so you're better off holding money and betting on a little rise and selling it then.
Well, we basically say we acknowledge that pricing companies is very is an art, not a science.
Yeah, not a science.
And
right.
that we kind of, when we sell half, if it declines, we buy more, and if it goes up, we'll sell the other half.
So what you're doing, to draw upon the lingo other investors is you're getting alpha after all. You're beating index funds. Basically, I'm referring to the perennial argument of passive investing versus active investing, which is usually characterized as, within the public securities markets in the United States, as either you can pick stocks and win, or you cannot pick stocks and win. Since you cannot pick stocks and win, therefore, you become a passive index investor and you rise with the market. But there's a problem with that, which, as you say, the market doesn't really rise over time during a sideways market. So you might be losing on the chance of some alpha that's out there, alpha that you get not by picking stocks, but by identifying specific companies through rigorous analysis that have upside more than just potential, maybe a little less than certainty, but much more than potential, and then riding those rather than passively investing in an index. Is that about right?
Yes. So when we analyze stocks, first we try, when we try to kill the company, we basically, Warren Buffett has a saying: rule number one, don't lose money, and the rule number two, don't forget rule number one. So the first thing we try to do when we analyze companies, by trying to kill them, we try to figure out what the downside is. Yes. And if there's very little downside, then and there is upside, and then we look at the upside, and if there is enough upside, then it becomes an attractive investment. Over the last 5 years, let me run this analogy by you. I live in Denver, about 2 hours away from Vail, and so when you live in Colorado, everybody asks me, do you ski? And I'm always proudly say I ski, and I always thought I was a good skier. Not Lindsey Vonn, but I thought I would go down the mountain usually faster than almost anybody else on the mountain. I was very proud of that. Last year, my kids and I went skiing in Vail, and before that, it snowed for 3 days straight. And I basically, it's almost like I never skied before. So it was a lot of snow on the mountain, and the resort was not able to keep up with plowing the snow, and so there was just a lot of snow. And basically, I could not ski. I would ski and I would fall, and my kids would be waiting for me at the bottom of the slope, and I fell probably 5 times every 20 minutes. It was like I never skied before. And then I talked to a ski instructor about this, and I said, "What happened?" He said, "Oh, it's very simple. When you skied before, you skied in the groom slopes, and when you're going very fast, your speed covered up your lack of skill." And so you thought you had a skill, you really didn't. You were going very fast. When there was a lot of snow, you actually your skill has to shine through. And now, and therefore, that's why you were horrible, because you really don't have any skill. And relating this to the market, over the last 6 years, the less skill you had, the better you did investing, because basically the Federal Reserve has manicured the slopes with low interest rates, and so all asset prices went up. So your skill did not matter over the last 6 years. At some point, we're going to have a lot of snow, and people who were just benefited from the price to earnings going up, and basically did not have a skill, you'll see their lack of skill showing up in their results. The market ahead of us most likely is going to be a lot less forgiving than the market that was behind us last 6 years.
So the name of your next book is going to be Snowbound.
Yes, it's kind of funny. I wrote this article. The interesting part, I wrote this article maybe 2 months ago, and I was going to publish it maybe 2 or 3 weeks ago. No, actually, but in this issue of Institutional Investor, actually. And the market had this hiccup. And my editor said, well, if you publish that article right now, people would think that you're disconnected from reality, because market, nobody thinks that investing is easy anymore.
Yeah. Right, but it seemed real easy just a short while ago.
Exactly.
Well, Vitaliy, I let you run long for this because it was so interesting. And I want to thank you very much for joining me.
Oh, it's my pleasure. Thank you very much, Chris.
That was Vitaliy Katsenelson, Chief Investment Officer of Investment Management Associates Incorporated. And you can read more about him at www.contrarianedge.com. Thank you for listening to Accredited Investor Markets Radio. Accredited Investor Markets Radio is produced by Stephanie Strait. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.